Well, good evening, everybody, and hopefully everybody can hear me. And welcome to another episode of, I call it like Trader Cafe series. Is it really? What we're going to do today is we're going to have a macro markets overview. So this is an opportunity for me to talk to you about what I'm thinking in the world and what's going on. And also really a chance for you to ask me some questions as well too about what's happening, and maybe we can relate it back to markets as well too. So let's kick off. First, I'd like to hopefully get my worried that we get this kicked off, that you guys can see my screen, and this might work. Brilliant. I hope that everybody can see that. Okay, so as always, we have to do a quick disclaimer, and just remember that everything I'm saying is for educational purposes only, and obviously if you decide to do anything, I can't be responsible for any of the outcomes. If you want to do anything special, please speak to your financial advisor wherever you are. So what this is really about is the opportunity for us to try and develop a little bit more of a background information. For those of you that remember my trading strategies, it's there's a three-stage strategy, which is market selection and market timing and then risk management. And this is part of the market selection. So we're trying to figure out a little bit about what's going on so we can understand the news and what's happening in it at a very high level, which gives us the opportunity to drill down into the markets which we know and we love, and try and figure out how we can therefore get the direction right in the broad sense, and then figure out how we can do timing. And that's what you guys have systems for, to do that timing element. What we're really talking about here is which markets do we look at especially. So let's kick off. So today I've got a few things I'd like to talk about. So I just minimize the chat button on my screen because I'm sitting here in very sunny Wellington today. I'm not at home in Auckland, and it's been a lovely day. For those of you who don't know, beautiful capital of New Zealand in Wellington, it tends to be a little bit on the windy side, and because it's midwinter, it's a little chilly here as well too, but it's been a fantastic day today. We have been incredibly lucky, meeting some great friends and getting to know the town a little bit better. So look, discussion points today. Okay, we're going to have a quick sort of, these are my thoughts really about what's happening. Look, you know, the equity markets in Europe and North America, I don't think they need much more explanation. Barely a day goes by without the market, careful how I say this, but crash into a new record high. And, you know, we want to try and figure out what we're thinking about this, because eventually markets don't continue to go up, and we need to try and figure out what the sort of timing or what the moment will be that could cause things to reverse. And I suspect the longer we carry on going up, then the harder and the faster any potential reversal is going to be. And maybe we can talk a little bit later on about an economist called Mr. Minsky and what it means when you throw pieces of grains of sand on a sand pile. And maybe we'll cover that a little bit later. In the meantime, I'm also going to talk about a little bit about what's happening in China. I don't think there's any secrets there to any of you sitting in Singapore and Hong Kong. You'd probably be front and center to understand this sort of news that's coming out. We know that regulators are getting tough. Also, credit spreads are widening a little bit because there's a bit of concern about the some of the public entities there and the debt load they're carrying, and the fact that the central government might not bail them out as they have been doing recently, or up until recently. And then really finally, what the impact is of possibly the slowing in growth that's starting to occur worldwide in the underlying markets of Europe and North America, and what that maybe means for China as well too. And you know, from our perspective, because we're traders, what does that really mean for the Shanghai market, and how is that going to perform against the S&P going forward? So then we're going to have a quick look at what I call Economics 101. I just want to talk you through, and sometimes people get lost in this, talk you through what the concept of the American stimulus means for stocks and why they're going up, and therefore at that moment in time when that stimulus begins to unwind or reduces or changes, what that's going to mean for investments in equity markets and possibly for the wider economy as well. We'll have a quick look through inflation and see what's happening there. I'm concerned that inflation in the US, which has always been the standout candidate worldwide, what's been happening in the US inflation, and that's changing recently as well too, despite another, well, not quite record high number, but certainly a very high number that we had this week. This was an inflation week, I think, numbers wide, with a number of different people that follow inflation, and also the inflation indices themselves being reported in the US. A quick look at Europe, because I'm not sure that growth is running away in Europe. And then finally, one of the things I really want to flag, and this is an important point today, and I've left it till last, but it's super important. We'll cover it in a bit more detail later on in this show. I want to talk about the major leg higher in the gold market, which I think is about to unfold in front of us. And when I talk major, I'm not talking about 2100. I'm talking about way higher than that. We may be about to start the next major leg up, and it's not necessarily related to what's going on in equity markets elsewhere. So key themes. You guys who have seen this before know the drill here. There's three main areas that I like to cover. The first one is inflation and what's going on there. The second one is fiscal deficits. It's summertime, so we're not really going to talk too much about that, but I will talk about that Economics 101 equilibrium model just for a few minutes. And then finally, the pandemic. And I think it's pretty fair to say that just about around the world, we're seeing the Delta variant having its impact, possibly on economic growth, but that's still got to come through the tape, if you like. But it's very clear that cases are rising pretty much everywhere around the world, as most countries, certainly the lucky enough ones that have the vaccine, are trying to rush to get people vaccinated as soon as possible to try and maintain the economic growth they have and not have to increase the government stimulus once again. But that's a clear risk on the horizon, and we're already seeing some of the impacts of that in places like Australia, where obviously the extended lockdown has had significant economic impact, but interestingly hasn't really shown up in the currency yet. So that may be a message that's quite interesting, I think, for the long-term future of the Aussie dollar. And I'll just mention it here because we're not really going to talk too much more about the pandemic after this, but isn't it strange, when you're thinking about trading, sometimes when you see the news and you see the news out of Australia, and pretty much all of it is quite dire. What else is going on in Australia? Well, what else is going on is you're witnessing a coal price internationally that just continues to rally and does not show any sign of stopping. If you look at the coal price versus the oil price, there's been amazing outperformance the last 2 or 3 months. As oil has consolidated, coal certainly hasn't. And one of the key exports of Australia is coal. And as that price goes up, you'd expect the balance of payments of the Australians to get even better. And as that happens, you'd expect in that case a general drift higher in the currency. Well, I think the pandemic, if you like, is holding that growth back. So there's a potential trade coming on there, I think, in the Aussie, where the Aussie is beginning to look too cheap. If they start to come out of lockdown, then you could easily argue that Australian dollar, if the price of coal remains at the levels it's at, could easily rally significantly towards certainly the 80 cents and maybe beyond. It may be towards 85 cents. So bear that in mind. As always, when you do, I often say to this is that, if the news isn't reacting, if the market doesn't react on the news the way you'd expect it to, then there's probably an interesting signal there. And maybe that's what we're seeing in Australia. So any other time you'd look at Australia and go, it's become a bit of a basket case. The currency should be falling. The economy is stalling, extended lockdown, yada, yada, yada. We all get that story. But what's actually going on is the Australian currency is holding firm, which I think is a very telling point for the bullishness that I have for the Aussie dollar. Maybe we'll see that unfold over the next 2 or 3 months or so, but I don't think that, and I've talked about it on this show before, I don't think it's time for the Aussie dollar continue its fall against the US dollar. I suspect it's going to reverse and go back up again here if Friday wasn't a start of that. Okay, so let's just actually, before we kick into this, I just want to talk really about that Chinese situation. Look, guys, I don't have many slides on this. Please go and look this up if you want to. But I think, again, those people in Singapore and Hong Kong, you probably know pretty much what I'm talking about with this because it's been out there. Regulators have been tough on some parts of the Chinese tech industry, I think, trying to be a little bit more proactive in the way in which they feel that the tech industry should be behaving. And that's had a negative impact impact on those share prices. I think that has been out there now for a few months. On top of that, we've had this credit spread situation slowly starting to unfold in front of us. The bond market in China has, if you like, taken fright to some extent with the credit spreads widening as a result of the state-owned enterprises in China, some of them which have traditionally been essentially continued to be funded on the back of increasing loans, so loans paying off loans. I think that now the Chinese central government is more comfortable with some of those institutions going out of business or being going into administration and being restructured, and what that's going to mean. But whatever it does mean, that's not positive for either the bond market or for economic output, because essentially things stall up. And really, whilst we're seeing good export growth from China, there's early indications so far that the exports are starting to slow down again. And that's really in line with what we're seeing both in Europe and also in America as well too. Maybe a little bit more on that when I show some charts up on that later on. So just be aware. I think I do have one chart. Let me just see if I've got the chart here. Here we go. Yep, look, I do have one chart on this that I think is interesting. So the green line on the bottom, so the top line is the Shanghai Stock Market Index. We had a big dip going back about 3 or 4 weeks ago, and the markets tried to recover a little bit since then. In scale, it hasn't recovered too much. We're still pretty much where we started the year. But if you look at the S&P, which is the green line below, I put a comparison there. The red is the Shanghai Stock Index and the green is the S&P. You can clearly see how the S&P has outperformed enormously the Chinese market this year. Now, the question is how is that going to converge and how is it going to happen for the rest of the year? Where's the convergence going to be? Is it going to be the US coming down or the Chinese going up? Well, that's the great debate. But if I had a trading position now, I'd be pretty comfortable putting that gap trade on, thinking that I would go for convergence trade just on a percentage basis. I think the Chinese economy, the Chinese stock market's got room to improve. And the US market may be looking a little bit overvalued, but as always with these things, it's the outright direction is a bit more difficult to come up with. So from the key themes, just really want to carry this through, right? So I've talked a lot about fiscal deficits, and I've said that it's summertime, nobody's listening, no government's in the office, everybody's out in the Northern Hemisphere. So let's get it back to basics, right? So when you look at anybody who does economics, right, economics 101, the first thing you get taught is this growth model or economic model. Okay, so the formula is really simple. So the Y represents the economy or the value of the economy. The C is consumption, the I is investment, and the G is government spending, and the final bit in brackets is exports minus imports. So we're going to assume, because as always with economics, we'd like to make a colossal amount of assumptions. So we are going to assume in this case that exports minus imports hasn't really changed that much over the course of the last year. There's been some shuffles, but nothing great. But I'm pretty sure that you guys all know about the what's been going on with government spending. So the government has been running a colossal deficit pretty much around the world. I don't think anywhere is immune, maybe apart from China, who have been a little bit more cautious, but pretty much every one of the other G10, G20 countries has run significant deficits. So when you see this in an equation, what you've got to sort of figure out is that if the aggregate level in the economy is pretty much unchanged compared to what it was a year ago, but yet we have had in the meantime a huge government deficit, then what has happened to the other side? Well, it doesn't take too much of a genius to work out that with that X minus M being pretty constant, you therefore have a colossal increase in investment and also a colossal increase in consumption. So how does that work? Well, look, anecdotally, why don't we think about this, right? So those of you who tried to buy a car in either in Western Europe, North America, Australia, New Zealand will know that you can't get one at the moment, right? Very difficult. Supply chains are constrained. And I don't think I need to repeat that story to anybody around the world. We're seeing supply constraints, right? Why is that? Well, people are trying to get hold of things and they've got money to spend. Why do they have money to spend? Because the government has given it to them. Right, so no great secret here, right? There's been a colossal uptick, if you like, in attempted, why don't we use the word attempted consumption, if you like. There's a lot of pent-up demand out there that hasn't quite been fulfilled yet. I think it's working its way through the system, but it's taken some time. And now look, the other side of it is the I. So where else has that money gone? Well, that money essentially has gone into investments. Now, what does that mean? Well, it means that when you've got nothing to do with your money, what you do with it is you stick it into some kind of savings account, or if you're an American, you stick it usually into the stock market because you don't believe in savings accounts. So consequently, what has been happening when we look at the inflows into the US equity markets is a good marker. We see that for the last 9 months, okay, the inflows have been higher than they have been for the last 10 years in aggregate, right? So you add up all the inflows into the stock market in the last 10 years, and you then look at what's gone on in the last 9 months. We've beaten that number. Okay, so there's been an enormous amount of money has flown into the stock market. So what has happened to stocks? Well, quite unsurprisingly, as we all know, they have risen, and they have risen enormously. Not always, and not in every case. There's been some problems. We all know that some of that investment's no doubt gone into cryptocurrencies, and that's been a volatile journey. Some of it has gone into the things like SPACs, which are vehicles to buy other companies. And if you read some of the headlines around that, people have lost a lot of money trading those recently. And so there's been some accidents, but by and large, when you look at the stock index, this is where the money has gone. And it's very difficult for a fund manager if you're receiving more and more money each and every day coming into your fund, not from the growth and the value of the fund, but from investors, that you've got to go and put that money to work as soon as you can. So that's what's been happening. So here's the change, right? We're always interested as traders in the rate of change, or the first derivative of all of this, right? So what we need to understand is what's going to happen when something changes. We've got what has happened, but now we've got to think about what's going to happen. So if that level of government spending, for instance, begins to reduce, we're not talking about tapering here. We're not talking about the Fed raising rates, nothing like that. We're just talking about the federal deficit coming a little bit more back into line again, so not quite as big as it was last year. Then understandably, what's going to happen to those two yellow arrows? They are going to start to fall. So again, the rate of growth will quickly stabilize in both consumption and investment. So what does that mean? Well, it means that not as many people are going to be looking for those new cars, and equally, not as many people are going to be putting money into the stock market. So inflows will start to tail off. So therefore, with the S&P up about 18 or 20% this year, then that's already been an amazing year by historical standards. It wouldn't be unreasonable to think that for the balance of the year, if the federal government stops spending money or reduces the amount of money it's going to spend, that we're going to see those inflows reduce, and therefore the stock market start to stabilize. So the issue is, will it stabilize or will it have a moment? Because essentially that money has already come into the market. It's bought, it's sitting in investment accounts. There's no more money to buy. So the government has to continue to spend at a very high rate to generate enough deficits in order to carry on with the inflows coming into the market from savers, right? And they may be corporate savers, and they may be private individuals, right? So really simple equation, really simple to try and get your feel about what's going on. And often when I talk to you about markets, this is what we're saying, although we say it in a slightly more technical way, don't we? So let's go and have a look at those inflation numbers. So when we looked at the inflation numbers that come out the last couple of days that have been published in the States, a couple of things really I wanted to highlight. And this is picked up by the guys at Alhambra Investments. Jeff Snyder is a rather brilliant analyst, and he's been calling for transitory inflation for some period of time, and I think this maybe illustrates why. So these faint red boxes you can see in the background of this chart, this is the month-on-month growth rate, and you can see it fell away considerably in the July figures, and we've seen a decline now for the last 3 or 4 months. Now it's begun to accelerate that decline. So what does that mean? It means that if you then average the rate of growth on a monthly basis, you get numbers that are way less than the 5% headline rate that you see for inflation as it stands today. And this is one of the key metrics to that inflation, which is the import price index. And again, when we look at the CPI, less food and energy, you can again see how the month-on-month change has quickly fallen back again. So reinforcing my view that I've had for a number of months that these inflation increases really are transitory in nature, and we are going to see this come back. Now, what's going to cause this to go wrong? Well, what's going to cause it to go wrong will be a significant rise in food prices, and also a significant rise in those things like those import levels and other general factors that cause inflation. So think of it in the US, they look at rents, on that people pay for their accommodation. That's a significant part of it. And sometimes there are some gaps, there are some delays, there are all sorts of reasons why things don't feed through immediately. We may see more of that over the next few months or so. But what I'm interested in is what that rate of change is, and that rate of change appears to be falling quite quickly. So what worries me is that it's transitory. Now, I don't think it's just me. Okay, because when you look at the 10-year bond yield, and if you look at this, and I apologize, decimal place is always weirdly in the wrong point. So we're looking at, even after Friday, a 130, 138 yield for the 10-year note. That doesn't suggest to me that there's any hint of inflation out there. So I reinforce the point I've made more than once in this macro overview, which is to say, if yields are at 1.3 and inflation's at 5.3, that's a 4% real, negative real yield. Just how long is that going to carry on for? So either the bond market's wrong or inflation is wrong. Right? So which one is it? Now, the bond market's a pretty big market, and it historically has an amazing record of forecasting inflation. So when the 10-year interest rate stuck at 1.3, I'm pretty certain that inflation is not going to get out of hand. And even the 10-year break even is sitting at 2.5%, right? So pretty much everybody believes that this inflation is transitory and it's going to fall back, not just quickly, but very quickly over the course of the next few months. So for the time being, I continue with my view that inflation is transitory. Yes, doesn't mean to say it's going to go down, right? Inflation, we're going to have deflation, but what I'm saying here is that I think that there's a transitory element to it. So what we see as 5 now might well be 3 or 2 in a few months' time. And hey, look, I just want to highlight the industrial production figures that have just come out in Europe as well too. So whilst the rest of Europe seems to be doing okay, German industry is really struggling, and that often because of the way in which German industry and the Chinese industrial landscape is so interlinked, suggests to me that really supports my case that things aren't as well as they could be, and industrial production is falling, and it hasn't picked up sufficiently since the COVID scare in any way, shape or form. If you think about where this number should be without COVID, you would expect to see this a lot higher figure than where it is at the moment. So that's a worrying sign and something really to bear in mind. So getting back to our key themes, when you're thinking about this from an inflation standpoint, I'm saying US is definitely transitory. We really haven't seen much feedback loop for inflation, but either in China or in Europe. It's sort of there, but realistically 1 or 2% inflation in Europe is hardly anything to worry about. And Chinese inflation remains very much subdued. Fiscal deficits, watch for the change. Any reduction in fiscal deficits means a reduction of inflows into the stock markets, which means trouble ahead. And then finally, as the pandemic unfolds, hopefully we will get on top of this as soon as we possibly can, and that the Delta variant will be the last Greek variant we ever have to worry about. We don't have to get into the rest of the Greek alphabet, because I'm pretty certain that the next variant or two may be more violent than this one, and that's the last thing that anybody wants. So with fingers crossed, we may be in a good situation over the pandemic in a few months' time. But right now, especially around the world, it's not looking so good, and you have to bear that in mind in your economic thinking, right? That will have an impact at some point in time. Just ask any Australian how they're feeling about it right now. So look, just really, somebody pointed this out the other day, and I thought it was an incredibly important point. Whenever and whatever we think is going on, we always have to look at the price. So remember that Australian dollar example I gave you, right? You've always got to look at the price to find out what's going on. And really, finding out what the world looks like is really not very hard. And again, knowing what to do as a result of that is also not very hard. Witness my point about these federal deficits in the States and consumption and investment. Again, this isn't rocket science, right? Anybody with a 101 course in economics would be able to figure this out. The big problem that everybody has, of course, is when to do something about it. And that is actually the incredibly hard bit. And people spend a vast vast amount of thinking time around the world trying to figure out what that means. So what I'm going to do now is to go through the what I call the Super Six. So I thought it would be a good time really just to have a quick look through what's going on in the 6 favorite markets that I'd like to follow around the world, and I recommend that everybody follows to get a good idea of what's happening in the world of trading, the world of volatility, and really, if you like, is the marker and what we use in order to determine how our system should work and how the markets that we trade, which are the ones which we should be looking at the closest at any point in time. So I recommend everybody follows the Super Six. It's not very hard to do, and that way, if you did, you'd be able to pick it up pretty straight away if there was any big changes. So what are the Super Six? So to go through this once again, for those of you that don't know this, and I apologize for repeating it for those of you that do, but I think that we have lots of new people joining this show every month. The Super Six currency-wise, we have the Euro US dollar and the US dollar Japanese yen. So why do we have those? Because each of those currencies, so the US dollar, the Euro, and the Japanese yen, cover each of the 3 major trading areas of the world. And the Japanese yen is a proxy for the Chinese. Not a great proxy, but it's a reasonable one for an Asian proxy. I also like to look at oil. Why? Because oil pretty much determines whether we have in a lot of cases whether we have recessions or whether we have growth, because the price of oil is essentially a transfer of wealth around the world. I like to look at gold because I do like to look at what the precious metals are up to, because they're quite a good indicator, back to that inflation discussion again, quite a good indicator of future inflation. And the S&P 500, because it's the world's benchmark stock market index. And finally, the most important one out of all of the 6, which is the 30-year US Treasury yield, because that sets the interest rates around the world. And without that, you don't have any idea what's going on. So you follow this one like a hawk, because that one tells you whether the world is in a good or a bad place, and what impact it will have on all of the above. Every single one of these other 5 markets is heavily influenced by this. It's the biggest market in the world and the deepest market in the world too. Okay, so when we look at the FX outlook, I think here are my key takeaways. At the moment, the Euro US dollar is in the trading range. It's stable, and we're waiting. At the moment, it's in the bottom of that trading range, and maybe on Friday we had a reversal, which may take us back to the middle of the range. You'll see what I mean for anybody when we look at that chart. Anybody who's a swing trader will understand that Friday's moves put a ring low in place off a previous low point. So interesting. And maybe there's a rally in store for the euro. Secondly, the dollar yen. Seasonal influence for dollar yen very much right now is bearish. We'll have a look at what that means from a technical basis by looking at weekly and daily charts, try and figure out what's going to happen next. And finally, I just have a quick mention really about a key cross rate for me, which is euro sterling. So my long-term viewpoint is that I think sterling is going to strengthen against a lot of currencies. The obvious one it's going to strengthen against is its major trading partner, which is the euro. And as a result of that, we watch the euro sterling rate very closely. At the moment, it's coming into the bottom of the recent trading range. My belief is we're heading back into the 60s from the current mid 80s as a long-term trend, if you like. And we really we'll have a quick look and see how that overall thought bubble of mine is performing at the moment. So when we start, let's have a quick start. And by the way, guys, if anybody wants to ask any questions, please just ask away. I've got the chat running here, so if you want to ask any questions, please do, and I'll try and pick them up as we go through the presentation. So here's the euro chart. This is a weekly. Again, those of you with a technical analysis hat on, you can see very closely that 2019 was a bit boring. 2020 was one very much of the euro rallying. And 2021 has been sort of punctuated with the euro really falling back. But we clearly have a defined range. Around the 117 area seems to be major support. And around the 124, just double check, get my levels right. Sorry, I have the camera over the wrong bit. There we go. Around the 122, 123 area is major resistance. So my long-term view is I think that the euro probably should rally from here. However, we always respect the market and respect what's happening. On a weekly chart, we do not have any major signs apart from a short-term bottom, which is a double bottom essentially. And you might well have seen this, but when you look at the daily chart, Friday was a pretty important day because we had a significant reversal upwards. And as a result of that, I tend to be slightly more positive on the euro until we take out 117.20. So again, volatility is so low at the moment. For me, there are so few trading opportunities in some of the foreign exchange area that I guess if I had to put some money into work in this market, I'd be a buyer of euros with a stop round about Friday's low. Because that would be a suggestion of continuation through that double bottom, and that could be a little bit more serious and might spin out into a much lower range. For the time being, it appears we bounced off that previous low, put a double bottom in place, and maybe we're heading back up towards the 119, possibly even the 120 area, and probably trade accordingly to that. Just while we stop for 2 seconds. Alexis has asked on the tape, how will the Fed tapering affect the US dollar? The first thing is, Alexis, there hasn't been any tapering just yet. There's a lot of talk about it. There's a lot of chatter in the press around what tapering should do and what tapering should look like. I think that withdrawing dollars from the market right now would probably have a US dollar positive bias to it, but there's a catch. Right. So the question is, why is the Fed tapering? Is the Fed tapering because the economy is forging ahead regardless, in which case the US dollar could well continue to tread water or go down, because normally when the economies of the world do well, you normally tend to see the US dollar fall because the general economic environment is relatively positive. And there's often lots of dollars in the dollars around. Right. If the Fed starts to taper and reduce those dollars, then you would expect, then with a fewer dollars out there, you'd expect the US dollar to start to rise. If that did happen, then is the Fed slowing the economy down, or is the Fed just reacting to a faster economic growth rate? So it's a little bit difficult to try and answer that question carefully. In my head, I would have said that could be US dollar positive, but really you've got to see what happens and see what the context is around them tapering. Were they the first to taper? They're probably not the first, the big one to taper. When you look at New Zealand and Canada, they both already talked about it. New Zealand's done it. It stopped tapering altogether. Not stopped tapering. Is that the right word? It stopped all the bond purchases, right? So all the QE in New Zealand stopped about a month ago. Hasn't really had much impact on the currency just yet, but I think that should be New Zealand dollar supportive if nobody else is stopping. And then we have to see what happens. I think stopping and then raising interest rates will be a very, very bad idea, but because you're doing a double whammy to the market. But we'll see what happens. So the short answer is I'm not sure. My gut instinct just tells me that the US dollar should strengthen slightly as a result of that, but you really have to put it into context. And look, guys, in terms of tapering, there's going to be no decisions made until after the Jackson Hole meeting, but I would definitely look at what's going on in Jackson Hole to give you some idea and some steer about what the Fed is thinking. And it's very interesting that we saw with a couple of weeks to go, then maybe the euro starting to put a double bottom in place and begin to break higher. That could be a pre-Jackson Hole move, but we'll have to wait and see. So when we look at dollar yen as well, so dollar yen is again this year been incredibly boring. Just look on the right hand side at what the range has been. Something like 108.5 to 111. It's like a 150 pip range over the course of the year. And again, Friday was interesting. So we saw a significant fall in dollar yen, right? A rally in the yen on Friday. Now, is that unexpected? Absolutely not at this time of year. If there's a move out there in the currencies that I'd be trying to play, it would be this one. And why am I trying to play it? Well, it's because of this reason. This is a weekly chart of dollar yen, but I really wanted to show you the seasonal impact. And it is at an absolute peak between here and also the middle to late part of September. So for the next 6 to 8 weeks, dollar yen is vulnerable to a decline. So if you saw, we'll just go back to the chart, if you saw that sell-off on Friday take place, up to that point in time, I'm aware of the seasonal influences, but wasn't really trading it. Now I see that trade unfolding. Monday's going to be an incredibly important day, because I think if we get follow through in dollar yen or follow through on the euro, that's something that you probably need to think about trading. Yeah, and Helen, thank you. Helen's just put a comment up saying, she says, I hear the Fed is holding back from announcing at Jackson Hole about any tapering. I look, the short answer to any of this is maybe they will, maybe they won't, and then they're certainly not going to tell us beforehand. I'm unconvinced that I just don't think the Fed's going to announce anything so far. When you look at their strategy is to ignore inflation, is to focus on unemployment. Yes, there has been some incredible strides made in unemployment, but if you look at the amount of jobs created in the economy, we are still way below where we were in March of last year. We still have a big gap to fill. And I think what the Fed's been trying to say is not only does it want that gap to be filled, but it wants to be pretty sure that we're going to create more jobs after that point and go to a new high, if you like. And as a result of that, they are not going to taper for some time. The market is trying to get them to do it. I have no idea why. I do not understand what the market's thinking around this, but we'll have to wait and see. The stock market's telling you right now that the Fed isn't tapering because essentially the stock market continues to rally, right? And I think on a Fed tapering, remember what that means, right? There's less dollars, less liquidity out there in some senses. So if there's less liquidity out there, you've got to be a little bit concerned, right? So, and then finally, I just want to show this chart of euro sterling. This is a monthly chart here. So my thesis has been for some time now that I think post Brexit, the UK will do very well. Well, at the moment it's traded, the currency, if you like, has been strengthening. So the euro has been falling against sterling, and we sit here at about 85 cents, which is the bottom of the trading range. I continue to believe that bottom of the trading range will be tested as we head back towards at least 70 over the course of the next 2 to 3 years. So my goal is to see euro sterling sold on any bounces. That's what I recommend. And whatever time frame you are within that bounce theory, then just trade it as you see it, possibly on the weekly and on the daily chart. One thing I want to just to mention here, sorry guys, I'll just move this around so I can see this this stuff myself. So just a couple of comments I've seen in the market over the course of the last few days, both in oil and other general commodity markets. I've watched this week some of the grains do very well again, and sugar's gone up again. Coffee came right off its high over the course of the last 3 or 4 weeks. So I've just had a quick scoot around earlier. But I think that what's going on is that the rate of growth of all these commodities, blowing up to new highs, may be happening in 1 or 2 of them, but I don't think it's a general move right now. I think the first leg of this secular bull market might well be over and over soon if it hasn't happened already. I'm not sure the price of coal can double from here, right? For instance, it's been doing very well, but it also risks, the higher it goes, it risks a greater correction. Over the medium term, right? Are we still in a bullish environment for commodities? The answer to that is yes. Does that mean we have significant inflation? No, it doesn't. I'm just in certain commodities, especially those ones related to the decarbonisation and the energy transition story, I remain incredibly bullish on. I think we're going to continue to see new highs in aluminium, in lithium, in copper. Oil will also do well, which doesn't sound right when you're talking about decarbonisation, but don't forget the way that the world works, right, is that people stop investing before they stop demanding the product, right? So that a lot of funds these days are pulling out of non-sustainable areas, which includes oil companies. That means investment is down in those areas, which means that supply will be restricted. And if supply is restricted, even if demand hasn't really changed that much, certainly hasn't gone up, but if demand hasn't changed that much, then with supply restricted, you're still going to see an increase in price, which is weird because especially if you're trying to get out of that commodity, why I'd expect the price to be going up, but it's just the way things are. Hence the reason why coal is doing very well. Everybody stopped investing in coal mines, so there isn't much coal left to supply. So any great uptick or movement in demand will create a consequent big reaction in the price, and that's what we're seeing. On top of that, you have markets like aluminium, lithium, copper, where there is a new set of demand coming down the line because of the decarbonisation, the move to electricity, and you need more copper for your EVs, you need more aluminium for your EVs, and of course you need a little bit extra lithium to make those batteries as well too. So with supply remaining relatively constant, this is a different story now. You've got demand outstripping that supply, so I would continue to argue that those commodities will do well, and all those companies that are involved in those. So whilst the first leg of this commodity bull market may be getting close to being over and or is subsiding in some particular commodities, overall the long-term force certainly for those markets I've mentioned there is still incredibly optimistic and will continue to do very well. Supply will not be able to keep up with demand. Again, I just reinforce that does not mean inflation for the general economy. That just means a good time for those particular markets. So let's look at the oil market right now. So we just scooting around this as part of the Super 6 again. So when we look at oil, what's really happened since July has been a consolidation, right? We got up to 76. So we're looking at WTI here doing incredibly well. And then the market decided to start consolidating, and we saw some really aggressive sell-offs. I'll come back to those, talk about those in a little while. So we're sitting here, we're about $5 or $6 off the high. The market has been relatively stuck, I think, for the past 2 months. Seasonally, there's no great shakes really about sort of June through to July and August. No, there's no great seasonal influences here. In fact, if anything, and maybe we'll have a talk about that. Have I got that chart in? Here we go. The seasonal influence on gold towards the end of the year is actually quite bearish. So we're almost starting that seasonal decline that starts about September, October time. Hence the reason why I'm going to maintain my view that it's going to be consolidation as part of a bullish trend. I am very bullish on oil over the medium term. I think it's going back probably to $100, if not higher. And I just can't tell you when that's going to be. But the reasons why is to do with that supply and demand constraints I was talking to earlier. Okay, so I've got some more questions here. Oh gosh, lots of comments from everybody. Hang on. So let's just take 2 seconds and cover some of these. All right, Helen's also said, Helen said the amazing numbers on the more jobs available than the numbers out of a job. It makes you wonder. You've got to be a little bit careful of those job available numbers, Helen, because sometimes what it really means is that people aren't prepared to pay any more money. Often when people pay up a little bit, it's remarkable how many members of staff they seem to attract. So I'll speak. Look, Helen, I'll speak about gold in a minute. Gold's had a bit of a rough ride the last couple of weeks or so, I'll talk to that. And look, and Lewis, thank you. Lewis is saying the US has asked OPEC to pump more, basically to ease inflation. Would that drive the oil price down if OPEC complied? Well, it's a great question. I think what the US was concerned about was that the driving season this year was so dramatically different to the one we had last year because of COVID, that there were going to be a significant increase in demand, and that the OPEC needed to provide a little bit more supply to make sure that was taken care of, because in the US shale market, production is starting to fall on a secular basis. So I think the maximum we had out of shale was like 13 million barrels, and we're now already down to 11. And there's no hope really of us getting back to those old highs again because of the way in which the shale market operates. So I think we're going to continue to see those numbers from shale fall as we literally run out of places to drill, quite frankly. So it's a very interesting situation about shale if you decide to investigate it. There's a lot of work being done now on the outlook for shale, and it's not really going to form a huge part of the world's oil supply really going forward for about 3 or 4 years time. The fall off will be quite dramatic. So look, I think what would happen if that driving season didn't turn out to be as good as people thought it was, and I've seen some figures saying it hasn't been. In fact, it's been quite subdued this year. Then you could easily argue that the world is probably a bit oversupplied of oil on the margin, and therefore, consequently, you'd expect the oil price to come down a little bit. Is that what's happened? Yeah, look, that's what's happened, right? The issue for me is what happens when we get into the seasonal bearish time around September, October, and what that's going to look like. Okay, technically, if it's seasonally bearish, we would expect it has done the last few years either to stand still or to go down in line with that seasonal movement. As you can see from the beginning of 21, it was a brilliant year for the seasonals. in oil, the market rallied considerably. Last year, we didn't see that negative seasonal influence be sustained. It started out, but didn't manage to be sustained. This year, maybe we might see that seasonal influence a little bit more prominent. So bear that in mind, because usually 2 years out of 2, that would be unusual if we didn't see this. We wouldn't normally see that happen. But these are crazy times. So anyway, trade the seasonals as you see it. I wouldn't necessarily be aggressively selling it in the seasonals, but what I would do is recognize a buying opportunity coming into the end of the year for oil for the next major leg up. Helen, nat gas has been consolidating a little bit. Some of that is technical factors that are related to the weather and storage, and let's probably not get into that. Right, guys, let's go look at gold, because I'm always conscious of time. We've only got another few minutes left, so a couple of things to say on gold. I think the key message from me is don't lose faith. I think there's about to be a major change in the gold market. When I say about to be, bear in mind I'm looking here at a monthly chart. I believe that this year is going to be a rough year for gold. However, it's going to be the last rough year for some time. I have been incredibly bullish on gold, and I just want to highlight something that a friend of mine pointed out to me the other day. This is what a secular move can look like in gold. Okay, this gives you some idea. Look at the scale on the bottom. We're reaching out to 2025 and 2026, but look at what's happening on the right. If you assume that gold right now sits about 240, which equals about 1800 in terms of the gold price, then what would happen if gold went up by a factor of 6? Right, that puts gold at about $8,000, $10,000, $12,000. That's what we're talking here. Okay, that's what the predictions are saying. When you look at the 60 and the 90-year cycles, we're at a secular bullish time for gold. What does that mean? It means that gold normally rises around this time every 90, 60 years is part of a cyclical time for gold. Timing is impossible here, right? This isn't a timing question that we're talking about. This is an investment question. But the opportunity is such that you shouldn't give up on gold or think that just getting back to 2100 will be brilliant. I am telling you here that I think there's probably more to it than that, and we have an opportunity to make a substantial amount of money out of gold. And whilst it's not correlated too well with stocks, it does get affected by stock markets, but in this instance, I think it's going to be quite resilient to stocks. And it's unloved at the moment, right? A lot of people think gold is in a bad place. We went up to what essentially 2 weeks ago was the resistance area, and we collapsed back from it. Most of that happened over the course of last week and this week, when there was a significant selling point in Asia on, I think it was last Monday, over $4 billion worth of gold, I believe, was sold on when we had that big Asian sell-off happen a few days ago, and that clearly destroyed all of the technical picture, if you like, from the very short term. So this is, when we're looking at this now, we're looking at a weekly bar chart. I know the market has recovered since, looking like it's put a tail in place. We certainly have a support point now. Hence the reason why I believe we're going to continue to consolidate over the course of the next few days. I know gold's a little higher here. This chart's a couple of days old, but gold's a little higher. We're going to continue to consolidate. Don't forget, this is a seasonally bullish time for gold, right? Now until the end of September, it's a seasonally bullish time. This big sell-off that we've seen, I think, is interesting and technically worrying. But whilst we're holding that 1675 level, I'm less concerned. And my longer term picture is I'm not too bothered about what the levels are. This still looks like a good investment to me. I have concerns because price of gold to make it is 1100 and we're trading at 1600. So where would you go? You're probably better off going to buy a gold miner because they're getting great margins at the moment rather than buying the gold price. But I believe both should trend higher over the course of the next few years. Hey, look, I haven't got a chart for the S&P today, and what I really want to talk about is the concept of convexity and Minsky moments. Please go and look these up on the internet. Minsky Moment is so Minsky won, I think he believed, won the Nobel Prize for his work on stability and non-stability, if you like, if that's the right expression. So his argument is that stability breeds instability, and I think what happens is how I like to think about it is that I prefer to call it complacency. And when I mean that, what I mean by that, I mean that convexity is created through complacency. So if you think about the model, right? Here's the model. If you try and build up a pile of sand by dropping a new grain on it consistently over the course of time, at some point in time you'll create an avalanche, right? But you don't know when that's going to be, and you're not sure which part of the sand pile is going to collapse, and you're not sure where the stability is, and you don't know what it's going to be. So work on the butterfly flapping in China creates something else happening in Europe, right? Principle. Okay, so chaos theory stuff. So what they're really saying with this is that you can't predict, but what you're doing is you're creating a degree in convexity in the market by the longer the belief that markets can't go down carries on, you end up creating a market that then goes down harder than when you first started. So that's what this is about. Okay, and I've quoted a guy called John Hussman. Please go and read his work. He's pretty amazing. Can be a little bit bearish at times. He's not a trader. What he is a long-term investor, and he has pretty huge concerns about the way the world is working right now in terms of the prices for most assets, but most importantly in the stock market, where he feels things have got completely out of hand. And most recently, I think the last couple of weeks, he wrote this piece, which I thought reflected a fairly frank view about what's going on. And look, just because the S&P rallied to a new high this week, we don't ignore these guys, right? They have incredibly important opinions. They're market thought leaders, and we mustn't ignore them because we do so at our peril. Doesn't mean to say they're right this week or this month, but they might well be very right over the medium term, and that, I think, is one of the key messages I want to bring home to you guys, right? So Helen's saying, not sure you understand the S&P story here. Very simple terms, Helen. It's going to new highs. It continues to go to new highs. The higher it goes, the harder it will come down. How does that sound? I hope that's the short-term message for what I wanted to say about that. Hey, look, one last final point, and I continue to reiterate this is the 30-year yield, as you can see. Again, ignore the decimal point. We're sitting right now at 195, roughly, something in that area, 2%. That is telling you there's no inflation out there. Okay, simple as that, right? So who's right, who's wrong? This is why I think the bond market has to be respected. It's also telling you that there's probably a problem down the pipe, but they're not sure when. So you would expect that if the stock market was a go forever situation, that you would have yields a lot higher than where they are now, and you don't. So, and also, if you thought inflation was going to be sustained for any length of time, you would have yields a lot higher than where they are now, and you don't. So this is my big indicator. It's had two or three goes at getting two or three absolute storming successes in trying to predict inflation in the past, when people have gone, oh my God, inflation's starting, and then it hasn't again. And we've had this two or three times in the bond market, telling you that that's a rubbish idea. And since 2011, I think there was one in 13 and one in 17 as well, 17 and 18. There were inflation scares both times. Both times it proved to be nothing because the bond market sat there at lower yields. So, look, guys, conclusion for the day. The euro, we're watching it. It's the bottom of the trading range. There may be a trading opportunity following Friday's price action. Dollar yen, exactly the same principle applies. You guys know how to trade it. I'm not going to tell you how to trade it, but you can see those trades as they unfold. Oil is sitting in a consolidation. I am bullish on oil. I'm really thinking about where you buy this. Gold, we're reaching an asymmetry point in a long-term bull market that I think is almost too hard to ignore. So we will get to the point, I don't know where it is. Let's say somewhere between 1500 and 1800 is the point at which this will set off for the new secular bull market move. And we've done wave one, we've had wave two, we've got wave three about to unfold. We could take gold an awful lot higher. I'm talking $5,000 to $8,000 higher. S&P 500, convexity and Minsky moments are everywhere. And finally, the US Treasury bond yield, I don't think it's too low. I think it's sending us a message. Hey guys, so look, just a quick comment on things. I was discussing this with a friend of mine the other day, and I think it's just important to mention to wrap up. This will be the last comment I'll make just in time. So look, just a quick comment really. The rate of flow of information and technological change is increasing right now at a pace that's equal to the rate of decline in due diligence. What do I mean by that? I mean that we hear lots of things happening about information, about technological change, but we hear it via a Twitter feed. So we have absolutely no idea what exactly it all means, and therefore it's quite difficult to try and understand. What this does is it increases the fragility of the system. Okay, so what that means is that you've got to constantly look for anti-fragile trades. What do I mean by that? Things that will not decline if everything else does. What's going to be the safe place to go? Okay, you do not want to be the guy buying the last grain of sand to fall on the pile before the avalanche, all right? I hope, Helen, you get that message now. So what I'm really saying with all this is look for those markets that will be secure over the long run. So remember those things about those energy transition markets, so copper, lithium, aluminium, silver. They're all important markets. And my comments about gold, guys, the chats are increasing here, so hopefully I can do it. From Lewis, I have no idea what's going to cause a sell-off in stock markets. Absolutely none, zero for the record. But right now it will be something inconsequential that causes it. I don't think we're going to have some major thing happen. I think we're way beyond that point now. We're at the point now where something inconsequential will cause a bit of a cascade and it will start. But I have no idea what that is or where it's going to come from. Okay, the rest are all people chatting, and guys, I think we're out of time here. I really hope you've enjoyed listening to this. It's been a little bit of a long one this time around, but I wanted to make a few points, so hopefully you've got that, especially the points around gold and around the energy transition. So, guys, thank you very much for listening, and I will see you in a few minutes if you're going to with the TTR radio. If not, I will see you in a few weeks' time.